Now, forget all of those rosy headlines about a bulletproof economy and that all we need is a Fed rate cut to send things surging into next year. Because Wendy's bombshell data, they just ripped the mask off the real economy. Now, as of March of this year, America's working poor. We're talking people who grind away at less than $75,000 a year in income. They've abandoned their staple Dave's single burger, and they've done it in massive numbers. And they didn't do it out of choice. They've done it out of sheer survival. Now, this isn't a menu mishap, the drive-thrus weren't broken, but what it is, it's the ultimate contrarian wake-up call that when everyday people can't afford a simple hamburger, that this entire strong economy facade is going to crumble like a house of cards on the brink of total collapse. Now, here's the shift you need, and here's what you need to do right now. Because this hidden crisis, it's not bad news. In fact, it's your opportunity to profit big, but only if you act now. Plus, on Friday, we nailed that silver trade and it's got stopped out for our CTA Timer Pro subscribers, and they locked in an 11.69% return in just under a week. Now, if you're ready to rake in gains like that, no matter which direction the market swings, grab those links in the description below for your free 30-day trial. Stay tuned to the end of the show to find out how you can get ahead when it comes to trading. Now, let's be crystal clear. Wendy's isn't an isolated blip, because when millions cannot afford a basic burger, it's the screaming leading indicator on why card payments are getting skipped, insurances are lapsing, and while credit card debts are snowballing into defaults. Because this low income squeeze is a classic leading indicator that flashes before every single recession hits. Ken Cook, he's the interim chief executive officer. He didn't sugarcoat it. He said Wendy's continues to see consumer pressure, particularly at the low end of the income spectrum. Wendy's has observed a persistent decline in lower income traffic since March. Specifically, low income traffic has been down in the high single digit to low double digit range. So what you can see here is something in the economy snapped in March. Something so bad, it made burgers unaffordable for low income Americans. And what it's doing, it's infecting the entire fast food scene. McDonald's is pushing desperate value gimmicks. Chipotle, they can't even sell burritos. So the question is, what switch, what change? Well, it all has to do with stagnant incomes clashing with rising inflation. Let's take a look at this chart of the Consumer Price Index in blue versus average weekly hours of production and non-supervisory employees in red. And I want you to see that weekly hours dropped right around March to around 33.7 and have stayed at or below that for most of the year. How about inflation? It's remained just shy of 3%. Without enough hours, consumers are being forced to cut back more and more. And without those extra hours, you can see paychecks, they're shrinking relative to inflation. What that's doing is forcing brutal cutbacks, even a simple Dave's hamburger. And you look back to that latest Gallup poll we saw in November, and it hits home. Low-income consumers are slashing holiday spending by as much as 46%. Because overall budgets, they're cratering here. We're talking a bigger drop since 2008. The bottom line is Americans, they're just flat out of cash. And when the working poor taps out, well, it cascades up into the middle class. And what that does is it shoves the entire economy headfirst right into the brink of a recession. Let's dive in, because this just isn't about burgers. It's about your job, it's about your finances, and your shot at creating real wealth. Because it's not just Wendy's who's sounding the alarm. Let's start with the big box retailers, because after quarter of talking up potential rebounds, Home Depot, they're now finally waving the white flag on consumer reality. Their latest preliminary forecast for 2026? Well, the company now expects comparable sales growth to be in the range of flat to up to 2% for the year, below the average rate of inflation. And what this does is it echoes Wendy's data perfectly. Low-income folks, they can't afford burgers. Now the broader consumer base is skipping those big-ticket home projects. In this next chart of real retail sales in blue versus average weekly hours of production and non-supervisory employees in red shows exactly the problem that's happening at Wendy's and Home Depot, because when real or inflation adjusted retail sales turns negative and hours worked are dropping, you can see a recession becomes a foregone conclusion. Now, we dodged one in 2023, and this had a lot to do with pre-trade war spending sprees, but now debt sitting at all-time highs, consumers are maxed out, the odds of a recession are rising by the day. In fact, Chief Financial Officer Rickard McPhail remains still holding out hope here. He says, "We believe that the pressures in housing will correct and provide the home improvement market with support for faster growth than the general economy." Let's be clear. this is denial mode because housing isn't bouncing back anytime soon because it's tied to the same wage stagnation that's hitting fast food traffic. And this chart of new privately owned housing starts in blue versus average weekly hours of production in non-supervisory in red, it proves it. As you can see, until hours go up and a bunch, housing demand is going to continue to fall. And when demand craters are like this, companies don't just tweak prices. They start slashing operations, and what that means is the labor market hard. Take PepsiCo, for example, reached an agreement with activist investor Elliott Investment Management to reduce its U.S. product line by 20%, lower prices, and at the same time, it's got to pare its workforce. And that's just right here at home for me. There was a recent shutdown in Orlando. It axed 450 jobs. In fact, CEO Ramon Lagarde calls it, quote, an opportunity to reinvest in value in a more substantial way. But this isn't growth mode. What we're seeing is companies shift into survival. Because Elliott built a $4 billion stake, but Pepsi's beverage share is declining amid consumer pressures. This is exactly like the low-income ditch at Wendy's. It's the same thing. So businesses can't afford excess anymore as production drops right alongside demand. So fewer products means fewer hours for workers. And next thing you know, what happens next? Jobs vanish. And speaking of jobs, retail, they're always the first domino to fall. Numbers here right now, they are grim. In the first 11 months of the year, the industry has recorded nearly 92,000 job cuts, with over 3,200 in November alone, just according to Challenger Grain Christmas. So I want to understand, these aren't seasonal blips. They're driven by softening demand, tariff fears, and shifting preferences. Now, normally holiday hiring boosts in November. We see an upswing, but not this year because layoffs are spiking when they should be dipping. And here's the proof in this chart. Let's go back to real retail sales, still shown in blue, now against the unemployment rate in red, meaning we're very likely to head into recession unless for some reason, for some unknown expectation, consumers spend big this holiday season. And so far, the surveys say it's going to be the worst holiday season since the financial crisis. So while the increased spending over Black Friday and the Thanksgiving weekend may give rise to hires in December right before the holidays, Challenger said it's unclear, however, if those positions will last into the new year. And the odds are they're probably not. Because I want you to be thinking, with margins and wallets getting squeezed, the real risk is less where we accelerate into the new year as companies continue to head into survival mode. And yet, amid all this, some businesses are clinging on to optimism that's starting to look like outright delusion, just like the CFO of Home Depot. The National Federation of Independent Business Optimism Index rose 0.8 point to a 3-month high of 99. The high came with a 9-point improvement in sales expectations, which was the biggest contributor to the overall increase in the optimism index. Now think back. ADP reported 120,000 small business layoffs last month. How does this even square up? It doesn't make any sense. And look at this. A net 34% said they raised their prices compared with 3 months ago. I warned this was coming. The largest share since March of 2023 and an increase of 13 percentage points from October. Now this isn't confidence. This is hope. Hope that people are going to buy these higher priced goods, masquerading as a complete strategy for their business. And sure enough, a net 15% of owners anticipate higher sales volumes in the next 3 months, the largest share since the start of the year. Here's what I want you to be thinking. Without wage growth and more hours, spending's not going to rise. It's going to crater even further. Again, if people can't afford a Wendy's hamburger, how are they going to afford higher priced goods? And for millions, reality is about to buy it harder come January. According to a recent New York Fed consumer survey, it showed steady inflation despite soaring expectations for medical care costs. Let's put some numbers out here. The median one-year inflation expectations, well, they held steady at around 3.2%. It's a little higher than where the CPI is right now. But year-ahead medical costs, and this is real, soaring 10.1%. That's the highest since 2014. And I can tell you, as someone who gets their medical through the ACA, through the exchange, it's a whole lot higher than that. But with job prospects still worse than last year and inflation still elevated, a greater share of households are reporting that their households were worse off compared to a year ago, and a smaller share reporting that they were better off. So let's be clear here. When health premiums surge in January, and they're going to, it's not going to matter if inflation cools or not, because essentials for many Americans, they're going to become unaffordable. And the debt risk, well, it's already flashing red and in a big way. The average perceived probability of missing a minimum debt payment over the next 3 months increased by 0.6 percentage point to 13.7. That's above the yearly average. So keep in mind, with income stagnant and costs rising, and again, this is the base case where people don't lose their job or see their hours get cut anymore, default, they're going to loom larger than ever. This is going to be bigger than 2008's buildup. And this is going to cascade all from the beginning of that low-income burger skip. It's going to get right up into middle-class bill skips. We're seeing that now. How many people are already skipping out on car insurance or cutting back? What this is going to do, it's going to take credit scores and take spending right along with it. In fact, even McDonald's is finally starting to wake up and get it. They're realizing it's about incomes, not gimmicks. Senior VP Andrew Gregory announced, quote, effective January 1st of next year, we're enhancing our global franchising standards across all segments to reinforce accountability for value leadership. A translation, hey, we've recognized that our prices are too high. Sales are dropping. Now, we've slowed it a little bit, but we're fearful that this is going to get worse. And we've got to make more cuts to keep our customers before they're gone. And under the new standard, the company will holistically assess pricing decisions for how well they offer value. Bottom line for franchisees, cut prices, get your customers back, push these value meals, or you're going to risk losing your franchise. So what's the payoff here? Well, this Wendy's burger ditch, it's not a fast food flop. It's a clear sign that consumers are running out of money. What this is, it's a canary signaling a 40 to 50% recession risk by early next year if wages don't rise or the Fed doesn't cut fast enough to create economic growth. But let's be clear here. Crises like these create winners for those who act smart and wipe out everybody else. Now, imagine turning this squeeze into your edge, protecting your nest egg while building wealth amid the chaos. First, here's what we need to do. Protect yourself right now. You need to diversify out of those vulnerable consumer stocks. You got to trim your retail and discretionary holdings. We're talking 20 to 30% here. And don't forget those tech stocks. Yeah, they're up a bunch. And guess what? It's time to take profits. Where do you need to go? Pivot to defensive. Think utilities, healthcare. They hold up pretty well during downturns. Remember Jeffrey Gundlach, he's the bond king. We keep pounding on us. He says to boost cash to a minimum of 20% of your portfolio. You're going to need it for dry powder to buy those dips. Instead of cash, consider short-term treasuries or look to be long the dollar. You may want to hedge with gold or silver. They've served over 20% in past recessions as inflation hedges. And when it comes to timing the swings, look for proven strategies like our CTA Timer Pro that nailed that 11.69% silver trade in a week. And right now, we're setting up for our next big win. We've already cashed in on a bunch of our gains ahead of the Fed meeting tomorrow. Now, let me show you just how easy it is to make money in both directions of the market. First, let's take a look at that silver trade again. Here you can see we bought it on the open on November 25th. We had an expected win rate of 63%, and 7 trading days later, we were stopped out for 11.69%. Now, how do we do this? Well, each and every day we look at the machine position across the broad equity, bond, currency, and commodity markets. And what we're doing is simply looking for a big wave of machine buying to position our subscribers ahead of it and get them out before the machines sell. Now, what we've done is we've taken this to the next level because these machines, they're not optimized, but we know where their threshold levels are, where they buy, and we fully optimize them and backtest them, giving you the edge. And when you have that edge, you know exactly which trades are going to generate the biggest potential win rate and the highest possible return. Now, it's so easy. All you have to do is sign up. You're going to go to the most recent date at the bottom. After you look at the video and instructions at the top, you're going to click on that and you're going to get an update on the stops of our trades. You're going to get my recommended trades for the day along with risk control levels and all optimized trades that were generated by the report. So you get all the tradable signals. You get my opinions on the best trades. You get full risk control levels, a tracking of all open trades and returns, a weekly update. And here's the best part of all. You get a 30-day free trial because that's how confident we are in our system to generate more trades like that silver one. So whether you're brand new to trading or you're an experienced trader using a whole host of other systems, when you try ours, you're going to see why we're the best. Now, all you have to do, grab those links in the description below, use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.